Greetings, members, one and all of the Salivation Nation. I have with me Lior Gans from Wealth Research Group. We have an exciting topic here today about the Federal Reserve and what they are doing with the rates, with the markets, and with the dollar. It's going to be interesting. And Lior, you have been following this for quite a number of years, and we've seen patterns with what the Federal Reserve has done in the past, but this is going to be quite different because some of the things that are going on now, we're at the precipice. So if you want to speak a little bit to about what the Fed is doing with what is conceivably going to be a pause and a pivot, and what that could mean for not only the dollar, but for commodities in general and precious metals in particular.
Sure. So first of all, let's define three important terms as we address this subject. One is what is a pivot? So a pivot is when you change from here to here to here, but you don't U-turn all the way. So a pivot would be the market expecting 75 basis points and the Fed doing 50, or the market expecting 50 and the Fed doing 25, or the market's expecting 25, the Fed not raising at all. If you want to track this on a daily basis, you should put on the Google search term CME Fed Watch Tool, and you will get the exact probabilities that the markets are now pricing in when it comes to the December 15 meeting. Right now, 80% of bond investors basically think it's going to be a 50 basis point rate hike. So a pivot in this case would be 25 basis points. I don't think there's a pivot coming. I think that they will raise by 50. And actually, if anything, contrary to what we saw in November, the CPI numbers will come before the meeting. In November, the meeting came on the 3rd or 4th, and then a week later, we had the CPI numbers. Now you're going to see CPI, and a few days later, the meeting. So you're going to have another CPI report before the meeting. A pivot to me, it means that they will be less hawkish than expected. I don't think that's happening. I think that they will raise by 50 basis points. And a U-turn means that they change their perspective altogether. And instead of raising, they will cut. I don't think that they will do any U-turn in the foreseeable future. When I say foreseeable future, I mean 2023 and 2024. So in the next 2 years, I don't see rates being cut at all. I see them raising to a point where the political pressure on them will be intense. And on the other hand, market forces will also play their role in alleviating some of the inflationary concerns. What's happening right now in the Fed is really interesting, the dynamics that are happening, because some of the governors are openly saying we can't be the one solution for inflation. You must have some government fiscal policies. So in other words, tax incentives, regulations, more housing permits, etc. You need to create these changes on the legislative front in order to help with inflation, obviously with energy and oil and foods, etc. Because these are things that the Fed can help less. The Fed's solution in general, by raising interest rates, is to make prices of equities go lower. And if you make prices of homes and of stocks go lower, then there are many things that change as a consequence. In other words, hiring becomes slower, or you need to lay off, and we're already seeing some layoffs in the big tech companies. And if you scatter this and really research this, you see that a lot of companies have frozen hiring and indeed are already firing some of the personnel. So we are seeing real world changes. What we haven't seen yet is a meaningful change in CPI to the downside, and I think that probably is coming. But I don't think that the markets truly understand how sticky and how entrenched already inflation is. I think it will take a few years for inflation to come back down towards the 3s and maybe to the 2s. But this is going to be a multi-year process. One thing that I created for your viewers is a report about how In February already, we said this is the end of the zero interest rate policies when the markets back then were pricing in maybe a rate hike or two and then cuts again. So we said, no, this is the end of that experiment of zero interest rates. So if you go to wealthresearchgroup.com/ZIRP or ZIRP, you will see that report. You can download it and you can understand how we thought about it and why we still think that is the case. And that's why I think rates will stay at these elevated levels for at least the next 2 years.
So that means that they will continue to raise rates on some level for the next 2 years. Now, you also talk about that the Fed will do a pause at some point in time. Is that a couple of years out?
No, I think they will pause in 2023. Obviously, within the Fed, there are extremes. There are those that already say we've tightened enough, and there's those that say that we over-tightened, and there are those that say we haven't done anything and that inflation is still raging. So you have that spectrum within the Fed. The debate is on what's called the lag. How long between the rate hike and the reality? How long does it take for interest rates to do their effect? Some say 3 months, some say 6 months, some say a year. And because there is such a big difference, it makes sense for the Fed to slow down and at some point to pause and to see if the reaction is still to come. What's incredibly damaging about the way that the Fed has done this is that they've given no guidelines as to where they're taking us in terms of interest rates. And then they've, once they did give a guideline in June, and that really helped the markets in July, you saw a huge rally, they all of a sudden changed again. So even when they set that, the goalpost, they started moving it again. And that's what the markets are really missing right now. Where are you going with this? Are you going to 5%, 6%, 7%? And I'll tell you why that's so important. Let's say you and I are buyer and seller of a huge multifamily complex with 300 units. Let's say I'm the buyer. And I come to you and I say, seller, how much are your rents on all these units? You tell me X. I tell you, perfect. Let me go to the bank real quick. I go to the bank and I tell them how much for a variable loan on this property. Now, I already know how much the rents are, so all I need to figure out is how much my payments will be, my expenses, and I can figure out if I can make this deal. Now, if interest rates are going to change on me, I don't know how much to pay. If interest rates are going to go higher, I should probably pay less. If interest rates are going to go lower, I can pay more. And if rents are going to go higher, I can pay more. So what is going on? And that's why you have a lot of industries that are frozen. That's why you have a lot of businesses that don't know whether or not they should focus on growth and hire more people, develop more products, or focus on profits and lay off people and focus on efficiencies. This is what we have right now in the economy. And that's why I call this a reset of interest rates, because you ran through a 13-year period where zero interest rates did not create excesses and inflation and froth and excitement and bubbles. They did not. They created an expensive economy. Things were expensive. Stocks were expensive. Real estate was expensive, but there was no bubble. You didn't have all the public speculating and getting into exotic products and buying Rolexes and cars, and you didn't have all that. So the Fed doesn't know how to stop the consumer from spending. What it knows is how to make life difficult for assets and then for asset owners. And from there, the asset owners usually are also the business owners. They will, a secondary effect would be that they would need to lay off employees or renegotiate wages, etc. That will slow down the economy. All these trickle effects. That's why there's a lag. And so what I think will happen is at some point, market forces, in other words, supply chains, the end of zero COVID policies in China, more production of oil, and just alleviating or easing the problem of energy crisis in Europe. All of these things that come from free market enterprise and from the efficiencies of entrepreneurs will start to help us with inflation. Remember that inflation, or CPI, is the change in prices. So in other words, if CPI month to month stays at zero, 0.0, it doesn't mean that we have no inflation. It means that inflation is still very high. In other words, that prices are still very high, and that they're not coming down yet. When you have negative or deflation, that's what you need to basically hope for if you want prices to come down. So what we're trying to do right now is to just stop prices from getting higher than they already are, but it doesn't mean that they're actually going lower. So this is important. In my opinion, what will happen is at some point during 2023, the impact of raising interest rates blindly and waiting for that trickle effect will no longer be the best policy for the Fed. They will reach a point where they really risk breaking down the economy into a classic recession, which is what they've been able to avoid thus far. You have a very robust jobs market, very low unemployment. But if the Fed's interest rates cause unemployment to go to 6, 7, 8%, and God forbid, like 10% or something that mirrors a massive recession, man, they will stop raising interest rates immediately, even on an emergency meeting. So I don't think that they want to go there. I don't think they should go there. And I think that's why you're probably going to see a pause in the first half of 2023. They will start to look at other things that they can do, like shrink the balance sheet and just wait. Okay, not lower rates, but wait. And interest rates are high enough to where people's behavior has changed. Household behavior has changed. Business dynamics have changed. They have changed the economy. They have reset this froth. I can tell you that when I talk to fund managers and to real estate developers, they tell me that the markets have changed. Things have changed. It's not easy to get cheap loans. It's not easy to decide whether or not to buy stocks or to go with bonds. In other words, TINA, which is the acronym for there is no alternative, that's over with. We are living in a new economy. And that's step one. The Fed achieved that goal. And now it's a matter of how painful this reset will be and how long it will be. In the meantime, one of the unintended consequences of it is that the dollar is technically extremely strong, and it's being treated as a safe haven, although it's a fake haven. You know, I wrote about that a lot. If you go to wealthresearchgroup.com/fake, you will understand why it is that with 40-year inflation, the dollar is actually one of the best asset classes in terms of performance in 2022.
As we move forward here, the Fed will probably want to pause before it becomes an emergency. And so this could lead to a new dynamic and a shift that will spark a commodity boom. Can you speak to that and what that could mean for not only the staples like, some of the metals like copper, zinc, lead, but also gold and silver? What are we looking at there, and how high do you think that could take gold and silver?
I have a different opinion on gold versus silver. So in my opinion, they're going to separate a little bit here. But in general, let's look at this scenario. A lot of the time, people try to make their decisions based on an hypothesis of how the economy would look and what's going to happen, and they create a forecast or a script, and they try to follow their own script that they made up, and that's not necessary. So while I tell you things that I believe might develop, it's you need to look at the right now, manage the risks that way. In other words, look at right now, look at the probabilities that things will go in a certain direction, and then do your own risk management, position sizing, etc. In a recession, gold is mathematically and scientifically the best asset class to own. So in a recession, stocks, bonds, real estate underperform, gold overperforms, okay? Outperforms. Silver doesn't perform well in a recession because it has a lot of industrial uses, and that demand goes down. If we are able to avoid a classical recession, which is what I believe we will avoid, then we will get to a situation where the dollar would peak, because the dollar is so strong because nobody knows what to do with money. Nobody knows where to go. Should I buy growth stocks, tech stocks, value stocks, energy? Where should I go? Should I buy bonds? Should I go I don't know, because if the Fed keeps raising interest rates, then obviously I'm overpaying for my stocks and overpaying for my real estate. So as long as the Fed doesn't give you a terminal rate, which is the end of their cycle, you just don't know. In that scenario, people hold a lot of cash, and right now the most crowded trade on Wall Street is long dollars. Once that's over, once that dynamic is over, and it will be during 2023, it will be over. We will get way more clarification from the Fed on exactly what their strategy is. So once that happens, and we're back to some sort of a risk-on environment where investors will look for where to put their money, the demand for holding cash will lessen, and that will create an outflow from the dollar back to assets. That's going to be phenomenal for silver. So in my opinion, as the dollar index peaks, if it hasn't already, the trade on silver would be amazing. You're already seeing silver at 22. It was below 18. So you already are seeing that dynamic happening. But I am talking about silver over 30, over 40, and going to the 50. So in my opinion, we are creating a generational top for the dollar. And as that generational top is formed in the dollar, you're creating basically, on the other hand, you created a generational bottom for silver. So that's why I really love silver as we head into that formation of a top. So there is time, and you will be able to detect the top. And not only that, but I'm telling you, it's a multi-year move. So even if you miss the first few months, the upside is going to be tremendous with silver. So this is my own personal analysis of the situation. If we avoid a recession, the dollar would peak in 2023, and silver will start rallying very strong. If the Fed mismanages the rate hikes severely and we see a classical recession, then gold will probably be a far better hedge. I don't know if you read wealthresearchgroup.com/out, but I think that it's important to read that because it talks about how inflation is probably going to toy with us, and it's going to be moving around. So in other words, you're going to see encouraging numbers in November, we saw. Maybe December will not be as encouraging. Then January encouraging. Then February not encouraging. You're not going to see a clear trend. And that is why the Fed will probably keep rates higher for longer than expected. And inflation is probably going to stay higher for longer than you think. And in that environment of very high bond yields, the markets tend to trade sideways. And in the 2000s, when you saw the markets trade sideways, commodities were the best asset class to be in, because in that sort of environment, their prices are higher and it's easier to create a profit model in commodities rather than in tech, where you need to spend a lot of money upfront on R&D. So in my opinion, we are getting into a nice bull market for commodities. There are other catalysts that are in the work here, one of them being deglobalization. And when the world deglobalizes and countries don't trust other countries, then it's not that easy to source your commodities from another country reliably. If the United States and China both want lithium from Latin America, then Latin America is going to jack up the price because it knows that both countries are going to do a bid war. And what happens in that scenario is, to guarantee that the supply will come to you, you need to offer that Latin American producer country either a guarantee or a premium. That's why I think commodities are going to go higher, and that's because of this new era of political capitalism instead of profit-driven capitalism, where you just go to the cheapest country that produces and you buy from them, no problem, because this country and you have no political issues, and there's no third parties that are trying to tell that country, don't sell to that country. That's globalization, when everything smoothly moves over the world. Now we're in deglobalization. Now that Putin basically escalated the deglobalization and created a situation where the biggest petrol station in the world is not selling to many countries, you are in a situation where, as a country, you must protect where you get your resources from. And sometimes it's not from the cheapest producer, and that will jack up the prices. Then on top of that, you add all of these compliance, ESG compliance, that makes it very difficult, if not next to impossible, to do mining and to do anything that has to do with the environment. and that adds to the price as well. So all of these create a very unique set of circumstances that's very bullish for the prices of commodities. And as I said, if you want to track silver, I think you should track the DXY index. It should be open on your browser at all time. And if you see the DXY going under 100, that's a sign that silver is definitely trending. And if it's go below the 95 and into the 90s, the lower 90s, at that point, I think silver could be well over the 35.
Where do you see gold in this kind of environment, considering it's seen more as a safe haven and not so much as a commodity?
I think in this cycle, gold is probably going to form a top between 25 and 100 and 3,000, whereas silver can form a top between 45 and 60. Just one point regarding gold. Gold became a tier 1 asset on April 1st, 2019. That's the day that the BIS, the Bank of International Settlements, changed the classification from tier 3 to tier 1. Tier 3 is where if you have gold, then that is a 50% collateral mark to market. And if it's a tier 1, it's 100%. So basically, what they tell you is that the price of gold on April 1st, 2019, in their view, is half of what it should be. And in April 1st, 2019, the price of gold was $1,291 an ounce. So even in the eyes of the central banks and the central bank of central banks, gold is worth $2,582, and that's before all the money printing you saw during the bailouts of 2020. So that's why I'm telling you between 2,500 and 3,000 is very reasonable for gold to go to in the next 2 to 3 years as we go into this bullish cycle. Many people don't know a hedge fund manager named Paul Singer. Not a gold bull, not a gold bear. He's just true to what's going on. Lately, he has put an investor memo to his investors in his hedge fund, and he's a billionaire. He's done amazing things throughout his life, including sue the government of Argentina to get paid on his bonds. He just issued a very alarming warning about hyperinflation. And I think if you want to access it, you need to be an investor in the hedge fund. But we got access to parts of it that went public and summarized it. So if you go to wealthresearchgroup.com/Paul, meaning his name, Paul, you can read on why many still believe that it's not as easy to solve America's inflationary problem with just raising interest rates and voila, it's done. Many believe that there are pockets of hyperinflation that could erupt, and I don't mean Weimar Republic hyperinflation, but in a developed economy like the United States, if you have a 5 or 6% inflation, CPI, for 5 or 6 years, you're basically ruining 30% of the savings and the purchasing power of Americans. And if you look at America being 25% of the world's GDP, 30% of that is about 7% of global GDP, and that's enough to send the world into a very deep depression. So what I'm basically trying to tell you is, first of all, read that report. I think it's crucial. And secondly, understand the dollar strength this year and the apparent paradox of, hey, there's all this inflation. Why isn't gold and silver going to the moon already? It's because the money hasn't flowed to gold and silver yet. It's not the time yet. And when we see, ironically, inflation peaking at these high levels and then staying there while the Fed is basically helpless against it, that's when you will start seeing both gold and silver doing their rally. So that's a little bit about the confusion regarding this.
All right. Well, thank you, Lior. I really appreciate your insights. I'm going to post a link to Wealth Research Group in the description below. But I want to thank you, Lior, for being here, and want to extend a multitude of gratitude to all of you for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.